Assalamu alaikum, dear student. Let's start a very important topic to end this topic. That relates to, of course, pension, but today we are discussing accessing the pension when an individual in UK becomes entitled to get the pension and what is the way to get pension. This topic is very important and it is very small when it comes to taxation. For ATX, this topic is little bit big. And again, you should not be focusing on this. The name of the topic is accessing the pension. Accessing the pension. Accessing the pension. Number one, the required age for pension is in UK it is 55 years. I'm not saying this is the retirement age. There's a difference. Retirement age could be 65 in UK. I'm not saying retirement age. I'm saying the age when individual becomes entitled to the pension is 55 years, which means that if someone is having age less than 55 will not get the pension fund and the pension income. So the number one rule which you need to know is in order to get the accessing the pension, the age must be at least 55. Now, second very important point. How do we get funds when we reach the age of 55 from the pension funds? Now, let's see that. Assuming someone has reached 55, now that person is getting the pension. How that person is going to get the pension? The rule says pension fund is exempt 25% lower of, let's say, A and B. Basically, you can say pension is exempt 25% lower of A and B. What is A? Funds available. Now make it pension fund, no issue at all. Number one, funds available at the time of 55. Funds available, and the second is lifetime allowance. Lifetime pension allowance, which is 1,73,100. So basically, the pension fund, when someone reaches the age of 55, that person gets pension. That person becomes entitled to get the pension, and it is exempt 25% lower of A and B. A is the funds available, and the B is lifetime allowance. For example, assuming the pension of available funds at the age of 55 is 800,000. Just I'm assuming it. Obviously, if the pension funds at the time of 55 is 800,000, then 25% which is exempt is lower of 800,000 and 1,73,100. So obviously we have to take in that case 25% of this, which becomes obviously 200,000. So this 200,000 is exempt for the recipient. This 200,000 is exempt for the recipient. Now the question arises, what about the remaining 600,000? Actually, the remaining 600,000, which is representing the remaining 75% funds, when an individual is going to extract the remaining 75% in the form of pension income slowly and gradually and as and when on required basis, then the remaining 75% when individual will be getting slowly and gradually, number one, that will be treated as pension income or pension benefit. On that pension income, individual is supposed to pay tax. Applicable tax rates are from the non-saving income. In the year when individual gets pension income, if he's a basic rate taxpayer, then he has to pay 20%. If he is a higher rate taxpayer, he has to pay 40%. If he is an additional rate taxpayer, then he has to pay 45%. It means on remaining 75%, applicable tax rates are 20, 40 and 45. Means the remaining 600,000, because 200,000 out of 8 lakh is exempt, still we are left with 600,000. Remaining 600,000 when an individual gets in the form of pension income slowly and gradually as and when required basis, then that individual will have to pay tax. Then it depends if individual in that year, in the year of getting pension income, if individual is a basic rate taxpayer, he has to pay 20%. If he's a higher rate taxpayer, pays 40, otherwise 45. When it comes to taxation, only you need to know 2 points. Number one, getting the pension, the age must be at least 55 years. Second, 25% lump sum lower of funds available and lifetime allowance is exempt. Third, the remaining amount when you will be getting slowly and gradually in the form of pension income, that will be treated as non-saving income, and on that non-saving you have to pay income tax. It depends. If you are a basic rate taxpayer in that year, you have to pay 20%. In case of higher, 40.